Welcome to Section 1 of the ASC 470 Debt Accounting Training Series for P&J Group. In this section, we lay the foundation. What debt actually is from an accounting standpoint, which standards govern it, and the key terms you will use throughout every other section. If you have ever wondered why the number on the balance sheet does not match what the company actually borrowed, this section explains exactly why. By the end of this section, you will be able to define what debt is and why it exists on a balance sheet, identify the major debt types P&J Group is likely to encounter, explain which standards apply and when, and use the core terminology fluently. These definitions are not just vocabulary. They are the building blocks every later concept depends on. Getting them right here saves confusion down the road. Here is the key thing to understand about debt from an accounting perspective. It is not simply what a company borrowed. It is a financial liability. The entity received real economic value, and it now owes that value back under specified contractual terms. Most people assume the number on the balance sheet is just the loan amount, but that is not what happens under a ASC 470. The standard requires the carrying amount to reflect the true economic obligation at every point in time, including the effect of fees, discounts, and premiums. That distinction is what this entire course is built on. The surprising part about bonds is that the price investors pay almost never equals the face value printed on the bond. When the market interest rate is higher than the coupon rate, investors pay less. That is a discount. When the coupon rate is more attractive than the market, investors pay more. That is a premium. Either way, the difference between what the company receives and what it must repay at maturity does not disappear. It is amortized systematically over the bond's life using the effective interest method, flowing through interest expense every period. Watch out for this one. Revolving credit lines are handled differently from term debt. Because the balance can go to zero, you cannot net issuance costs against a liability that might not exist. Instead, those costs sit as a separate asset on the balance sheet and are amortized over the facility term regardless of the outstanding balance. Non-interest-bearing notes are equally tricky. The absence of a stated interest rate does not mean there is no interest. You must impute a market rate, discount the future cash flows to present value, and recognize the implied interest expense over the note's life. This is where things get interesting. Convertible debt used to require companies to split the instrument into a liability piece and an equity piece. That created complexity and artificially inflated interest expense. A SU 2020-06 changed the rules. Most convertible debt is now a single liability instrument, which simplifies the accounting considerably. Related party loans carry a different risk. The standard does not accept stated terms at face value when the lender and borrower are not dealing at arm's length. If a parent company lends to a subsidiary at 0% interest, accounting requires you to impute a market rate and recognize the below-market benefit explicitly. ASC 470 is not a single standard. It is a family. The -10 subtopic covers general debt recognition and classification. The -20 subtopic covers convertible instruments. The -50 subtopic, one of the most practically important, covers what happens when debt terms change. And a SC 835 sits alongside, governing imputed interest and interest capitalization. Understanding how these subtopics fit together tells you which guidance to reach for in any situation. We will visit each of them in detail across this training series. Most people assume debt accounting stops at a SC 470, but that is not what happens in practice. A SC 842 creates finance lease liabilities that behave exactly like debt from a measurement standpoint, same effective interest mechanics, but they live on different balance sheet lines. A SC 815 is relevant whenever a debt instrument contains an embedded derivative, such as an interest rate floor or a conversion option that meets the derivative definition. The first question you must always ask is, which standard governs this instrument? Getting that wrong from the start means rebuilding the entire accounting model later. Here is the distinction that causes the most confusion in practice. Face value is fixed. It is the amount written in the contract that the company must repay at maturity. Carrying amount is what appears on the balance sheet, and it changes every single period. They start apart because of discounts, premiums, and issuance costs, and they converge at maturity. The carrying amount at any date equals face value minus unamortized discount minus unamortized issuance costs plus any unamortized premium. Memorize that formula. You will use it constantly. The effective interest rate is the single most important number in debt accounting. It is not the coupon rate on the face of the bond. It is the rate that, when applied to the carrying amount each period, produces the actual economic cost of borrowing, including the effect of fees and the discount or premium. The surprising part is that applying this rate means interest expense is not constant. It moves every period as the carrying amount changes. ASC 470 requires the effective interest method, unless the straight line method gives you a number that is not materially different. In practice, for significant issuance costs or large discounts, the effective method is almost always required. Watch out for this one. Debt issuance costs used to be presented as a deferred asset on the balance sheet. That changed. They are now deducted from the carrying amount of the debt, just like a discount. So when a company borrows $1 million but pays $15,000 in bank fees and legal costs, the debt is initially carried at $985,000, not $1 million. Over the life of the loan, those costs flow through interest expense via amortization, raising the effective rate above the coupon rate. The same logic applies to discounts and premiums. They all unwind through interest expense, period by period until maturity. Most people focus on measurement and miss this entirely. Covenant violations have immediate balance sheet consequences. If a company breaches a financial covenant, say a minimum EBITDA or maximum leverage ratio, the lender may have the right to accelerate repayment. And if that right exists at the balance sheet date, the debt must be reclassified from long-term to current, even if the lender has not actually demanded repayment yet. Cross-default clauses make this even more serious. A breach in one agreement can trigger default provisions in others. This is one of the most judgment-intensive areas in debt accounting, and one of the most consequential for financial statement presentation. We will cover modifications and extinguishments in full detail later in this series, but here is why the concept belongs in your foundation. When a company renegotiates its debt, the accounting outcome, continuation versus extinguishment, depends entirely on a single test. Compare the present value of the new cash flows to the old cash flows using the original effective rate. If the difference exceeds 10%, it is a new debt arrangement. All the old accounts are removed, and a gain or loss is recognized immediately. If the difference is 10% or less, the original debt continues, just with updated terms. Two very different accounting outcomes from what looks like the same business event. Let us bring Section 1 together. Debt is a financial liability representing a true economic obligation, not simply the face value on a note. ASC 470 and its related standards ensure the balance sheet reflects that obligation accurately at every reporting date. The carrying amount will almost always differ from face value because of discounts, premiums, and issuance costs, and those differences are resolved through interest expense over the debt's life. The effective interest rate is how you track that resolution, and covenant compliance is not just a legal matter, it directly affects balance sheet classification. Thank you for completing this section on the foundations of debt accounting. Thank you for watching. Subscribe for more training from P&J Group.